Hello and welcome to this week's webinar, the Market Outlook with me, David Jones, and Aondo Markets. This is a webinar that we do every week on a Wednesday lunchtime. If you're watching the recorded version of this, it was held at 12:30 on Wednesday, May the 31st. And what we try and do is incorporate a couple of things in this. First of all, obviously, a look at what markets could be interesting over the next week. And we've got, on Friday this week, we've got the non-farm payrolls, the US unemployment numbers, coming out at 1:30 UK time. And that's always usually guaranteed to add some volatility into markets. Then, of course, next Thursday, we have the UK general election. And we've already seen the pound move overnight a bit. It's bounced back, actually, but on news that we could end up, or the Conservatives, according to one poll, worst case scenario from the poll, could end up with no overall majority. So I'm sure plenty. We've been used to the pound being buffeted by Brexit talks over the last 12 months, and I think every little wiggle running up to the election will see some more volatility there. But we'll take a look at the pound because I think it's interesting because it's been knocked back to where it has overnight. It could be an opportunity. Before we get started into this, a quick word from our sponsors. So I do this every week in conjunction with Aondo, and they've got a deal on at the moment. There's a signal service from a company called 3 Markets, who are, I think, a German company, and I think it's normally about €99 a month. But the deal Aondo have got at the moment is if you put €3,000 or the UK GBP or other currency equivalent into an account before the 7th of July 2017, you'll have access to the 3 Markets signal service free of charge for 6 months. So to find out more, go to aondo.com/en/3markets, and there'll be details about that on there. Right, let's get cracking. So let's take a quick look at what's going on at the moment. Let's look at the pound first of all, and then I'm going to jump and talk about this trend strategy, where to jump into a trend, because I think it's pretty relevant at the moment, given what's particularly what's going on with the pound. But I don't think it was that big a move. I think it's maybe been overplayed a bit, the size of the move. But it was trading last night. What time was that last night? About 10 o'clock last night. The pound was trading around the 128.60 level. Then news came out of this this poll that was going to be in the Times today, suggesting we could end up with some sort of hung parliament or something. And you can see the effect it had. This is a 10-minute chart we're looking at. So it lost, what did it lose? It lost about 60, 70 points in pretty short order. Bounced a little bit in the Asian session and weakened again this morning, maybe when London got its head around that news. But we've seen something of a rally off these levels. I don't think it really changes. This volatility doesn't really change the outlook for the pound. It was only, a couple of weeks ago, we were trading at the best levels since September last year, up above that 130 level. You know, we've seen 120 was a good base for the last 3 months of last year. So for my money, at least, the trend on the pound is still up. And I think maybe the risk is that we'll see the market squeeze a bit higher. Obviously, it's surged over the last couple of months or so. So there's scope for a bit of weakness. But for me, I think my outlook would be for the pound to continue to push higher. And I think that maybe the ultimate target at the moment is for a run up to those summer highs in the sort of 134, 134.50 area. And if we plonk our trend line on, which is the one I want, the high-low line, if we plonk it on, let's say, I don't know, from here, I think that trend has come under a bit of pressure. But for my money, you know, we're still in that trend, even though it's had a little bit of a wiggle through over the last 4 days as the market's gone sideways. But I'm going to talk about this trend idea a bit more now, and also go through, I think, a trade that I've done over the last week, really designed around following trends, because we all know that we should trade with a trend. It's the classic mantra, isn't it? You know, the trend is your friend, trade in the direction of the trend. Most people don't, which is all well and good, but I think it can be difficult to know where to get in. So first of all, let's just look at the theory of the trends. Okay, so let me just bring up some scribbles on here. So hopefully what you can see on your screen now is me scribbling away. If someone can just confirm that yes, they can see my not very artistic squiggles on there. So we have a market that's been going down for a while, reverses, and then starts to rally higher. So we have classically, we'd have our trend would sit something like that, our trend line. Now, I'm not the biggest fan of trend lines, but I will plonk them on charts so I know which way the trend is going. And the textbook approach, I think quite rightly, I wouldn't take issue with this. If we see a trend forming, then if it dips back towards the trend line, we want to be a buyer in this example. And of course, in this prior example here, every rally back to the downtrend will be an opportunity to sell short until this happens and the trend breaks and we've got potentially a change in trend. So I think it's quite simple, as I just demonstrated on that pound chart, to identify trends. I think the question is, where do we get in? And I think there's first of all a couple of obvious problems. I think people will just jump into trends blindly, assuming that it's just going to carry on, which isn't the case, because if you jumped in here, maybe the market would do this and give you a bit of pain on the position before it did possibly continue. The other thing that people do, of course, is to try and go against the trend and think, well, the market's gone up for so long, how can it go up much further? Again, that's a very dangerous approach. So what we just want to try and do is formulate a method for trading with the trend. And I would suggest, we're going to jump back onto the pound chart in a second. I think what we are looking to do in a downtrend is buy the dips. And I'd look for really obvious levels, because it's all about, where's our stop loss going to go? So if we're buying up there, the problem is, you may decide to have a random stop loss, a 30-point stop loss, which might, come in there. The market can easily take you out of that position, but the trend is still valid. So I think if we're buying into a trend, whether it's an hourly, a daily, or even a 10-minute trend on the chart, we want to set our stop loss at a level that if the market breaks that level, well, yes, there's a big chance that the trend has changed. And I suggest the obvious one here is the prior low. At the very least, that's where I would want my stop loss, or even more conservatively, a couple of lows back. So I don't necessarily want to be buying up here, because my risk is going to be too great. But if we get a pullback and the market blips a little bit higher, we see signs of support, then that is, for me, I think the obvious place to buy in. A more aggressive strategy, if we've got a runaway market, and we'll look again at a couple of, the S&P is a good example, which, again, over the last week has broken out to fresh all-time highs. An aggressive strategy is to buy the breakout. So if we, let me just take a couple of steps back and just delete some of this stuff. I've deleted everything. That was a stroke of genius. Let's say, a market's doing this, and we're watching it and thinking, okay, is this market really going to get going? Then if it breaks out in this example to fresh highs, we'd have maybe a buy order up there, so we're in on the breakout. The problem with buying breakouts, you're hoping that the market is going to go maybe parabolic, but if the market just does its normal thing, sells off a bit, you're going to have a wider stop, which is fine. If you're expecting a big move, if that's your stop loss and you're expecting a move of that sort of magnitude, it's still a trade that makes sense. So that way, we're buying into strength rather than waiting for the market to weaken and try and buy in at a cheaper price lower in the trend. But again, we'll look at a couple of examples of that in a second. So let's jump back onto the chart. Let's take as our example, let's look at this pound chart, because I'd suggest, as ever, being Harry hindsight, there was a trade this morning, and there might be if it sells off this afternoon. Looking at this chart here, we can see that since March this year, the trend has been up. So we've had 3 months of rising pound against the dollar. The trend for me was confirmed as valid, by the fact it punched out to its best level in about 6 months when it moved, through the 130, well, actually through the 128 mark back here. So this is a trend that is strong. So from a textbook point of view, even though I think plenty of people would have been trying to call the top in pound against the dollar, for me, what I want to try and do is buy into the trend. And I think that there's a really obvious level of support here. We had the surge up on whatever news that was, I can't remember what it was, a bit of a wiggle for a couple of weeks or a week and a half, and then bang, off goes the market again. So we have left good support back here. So let's plonk our line on. Here we go. So we want horizontal high-low line. Here we go. So we want that level there. There we go. So 127.57. That's the low from the second half of April, by the looks of it. Okay, so that's our low in there. So again, for me, if I was buying at 130, I'm probably thinking, well, maybe under here goes my stop loss, but ideally back here, which is 250 points away if I was buying at 130. So weakness like we've seen over the last week, you know, I suggest is a good opportunity for the trend followers. Let's flick this out to an hourly chart. There we go. So if we highlight that level again back here, it's this to that 127.57 low. So where the market is trading now, or where it was trading a couple of hours ago, was a better entry point. But if it comes back to that 128 area, it looks like a good place to buy into the trend. You know, assuming we're going to see the market rotate its way back up to 130.40. You know, so for me, if it does lose that 127.50 level, it does throw into question. I think maybe the trend's having a bit of a rest, and maybe we do want to be out. It had such a sharp rise, you know, we could see, you know, quite a pullback maybe towards the 125. But while we're above there, it looks like, I think, a good opportunity. Also added into this, if you remember from when we were talking about, I think the squiggly lines in recent weeks, it's not a perfect example, but we did have this morning. Where was it this morning? Let me put the crosshairs on it. So it would have been 9 o'clock, between 9 and 10 this morning, that big red candle was made. So between 9 and 10, with the big red candle there, where the market sold off and then reversed pretty sharply back above 128. But we had this bullish divergence. So we had the market slip to a low, so we made a low. The RSI dipped briefly, very briefly it looks like, into oversold. Market rallied a bit, pushed lower, but the RSI made a slightly higher low. So this little setup here is known as bullish divergence, where the market slips to lows, but the RSI doesn't follow suit. It can be a suggestion that maybe the trend you're following is running out of steam, the weakness, the downtrend in this example. So for me, it looks like a buy, you know, whether you buy it here. So let's say we bought it here. Where is it now? 128.39. So we're going to buy it at 128.39 with a stop at, I don't know, 127.35. So we've got a 100-point stop loss in that example, and we've got a couple of 100 points if we think the market is going to go up and retest these old highs. That's not bad. You know, at least we've got a reasonable risk reward on the trade. We've got 2 to 1. You know, we've got twice the potential profit versus our loss. Personally, I'd probably rather wait and see and maybe put an order in, try and get it at 128 with a stop again at, let's say, 127.40. So a 60-point stop loss and 240 points upside if we got filled at 128. So we've got, you know, a 4 to 1 trade there. But either way, it's going to be an interesting one to watch, I think, because of the election coming up a week tomorrow, but also because this has been such a big level, I think, over the last 6 weeks or so, isn't it? Something like 5 weeks. So I think it's a really 127.50, 127.60, big level to watch in pounds against the US dollar. But I'd expect it to bounce back up from here. So that's the idea of buying into a trend when it pulls back to support. I'll just show you one I did, which is a bit of a longer term one, but it was on a share. So I do sort of bits and pieces with shares, sort of medium term stuff rather than sort of in and out the same day. But this is WPP. So I'm talking my own book here, obviously. So I should say that I'm in this one already. But WPP has had a fantastic trend over the years. So Footsie 100 share, big media company, blah, blah, blah. 2008, it was £3.25 a share. Today, it's £17.50 a share. But for me, the trend, you know, hopefully the trend is pretty obvious to you as well. You know, it's pretty clear what the trend is here. You know, we've got, if we go back to these lows, October 11 lows, there you go. Our trend is clearly up. You know, so for me, any weakness in something like this is a buying opportunity. And let me just tune into the dailies, because I did this off the daily chart rather than off hourlies or anything like that. So we have our trend, which is obviously up. During March, it punched out to fresh all-time highs above £19 a share. It came back down, there we go, in end of March for whatever reason, to £16.50, which was also a big level here, you know, from just before it surged higher. This is a perfect setup, this. So almost touched exactly the same level. So this £16.30 level had held the market up a couple of times. Share price got clobbered, came back again. I missed it here, I should have had it here, but I eventually got in, I think it was about 4 days ago. So I got in at 16.95, about there somewhere. And really, you know, the logic is exactly the same as the pound trade. And I think this is a good example. I think identifying trends in shares, you know, for people who don't want to sit there and watch the screens all day long, or don't have time to watch the screens all day long, or have better things to do with their life than watch numbers flash all day long. You know, you can see these on daily charts. You know, I remember I spent a lot of time just looking at stuff at the weekends. You know, looking at going through like the Footsie 350 over a weekend, trying to find setups exactly like this. So I'm in my stop loss. So I'm in at 16.95. My stop loss is 16.25. Say so it's a 70-point stop loss, and I'm expecting the market to at least go up to here, if not through again. You know, so I've got a good 200 and something, 250 points on the upside, and maybe 70 points risk on the downside. So it's a trade that makes sense from a risk reward point of view. And so far, you know, it is behaving itself. It's doing what it's meant to be. So that's an example of you know, a pullback on a longer term time frame, and we saw it on pound against the dollar on a shorter term time frame. Let's have a quick look at the S&P and talk about this breakout strategy. It's maybe not the best example to use, the S&P. So this is the broader US stock market index, the S&P 500. It would have been a good example, again in hindsight, to have used it on the way up after the election. But the trend is still definitely up, but it just seems to have lost a lot of momentum recently. But the sort of thing we're talking about when we're talking about breakouts, so the breakout example I give is where we have, you know, a market where we've got a definite barrier. So the S&P all through August, all through the summer, could not get through 2194. So you can see it just kept banging its head, banging its head, banging its head. Then we have the presidential election, massive volatility. The market moves up to that level, hesitates again, but bang, it goes through. So a breakout strategy is just buying as soon as the level is broken, is one approach. And it's a little bit, I think, finger in the air as to where your stop goes, because you need to set it somewhere the other side of the breakout, but we haven't really got anything in the way of obvious support. Perhaps the more considered and conservative approach is to recognize the market has broken out and look to buy the pullback. You know, so we did have this move that went on for about 4 days. So the market punched higher, then spent about a week selling off, then reversed, and bang, off it goes. So maybe the breakout of the post-breakout high is one idea, I think, for trading. So if I was going to say, there we go, that was how high the market got after the breakout. So when it breaks out again, confirming, maybe giving more validity to the breakout, we'd look to buy in here, and you have, I think, a relatively logical level for your stop, where it dipped back down to after that first breakout. Hopefully that makes sense. Let's just walk through this. Breaks out through the level, pushes higher, doesn't go parabolic, sells off a bit, pushes higher again, but then breaks that previous short-term high. So that could be maybe the more conservative signal, buying in at 22.20 with a stop loss the other side of 21.80, whatever that level there is. Okay, so hopefully there's a couple of ideas there about how to trade breakouts. Saying all of that, you know, if we zoom in to where we are now, these US markets are still strong. You know, there's no doubt about that. But we haven't seen, you know, because the breakouts worked pretty well. December, the market was sort of struggling, and then broke out, came off, broke out, and off it went again. But since March, even though we have seen new highs in the US stock market, we haven't seen much of a follow-through. Even the one we're in at the moment, which broke out 25th of May, you know, we haven't actually seen it progress much further since then. Maybe we'll see it today. Maybe we need to get the payrolls out of the way, you know. But either way, I think at the moment, any dips in US stock markets look to be a buying opportunity. Just one last thing on this trend and breakout stuff. Then we'll take a broader look at the markets. Let's go to euro dollar, because euro dollar is another one that's had a good run recently. And I think last time round, I was looking at this. Were we looking at bearish engulfing somewhere? Oh, here. Was it bearish engulfing here? This was a week ago, wasn't it? So maybe this is an opportunity to sell short. And the market did push a bit lower, and it's pushing back up to where we were talking about it a week ago. So euro dollar's had a good run, but we are, I think, getting near to what could be resistance. This whole sort of, I don't know, 113 to 114 area, just above where the euro is trading now. But to go back to the subject of breakouts, if you look on an hourly chart, yeah, the sort of thing, if you do get these markets that are runaway markets, let's look at euro back in May. So it made a peak on May the 7th, about there we go, and then broke it out. If you were waiting for the pullback never actually came. Okay, and the market just moved higher, sold off a bit, broke out again, and since then we've just been a little bit sideways. So I think it can work over all sorts of time frames. I'd suggest maybe the most reliable place it works is on daily breakouts. If it breaks a big level on the daily chart, I think you can maybe have a bit more success. And so again, I think if you stuck to, or if you were interested in shares, coming up with a short list of potential shares to trade, looking for stuff that's breaking out, I think is a good way of doing it. Right, let's take a look at the broader markets. Like I say, it's been a little bit dull. We looked at the S&P, which has broken out to fresh highs. The Dow, I think it's quite interesting, the difference between the Dow and the S&P at the moment. So the S&P in the last week has set fresh all-time highs. But look at the Dow. It still can't do it. It set its all-time high beginning of March up here, 21,170. And it comes very close to that level, but can't get through. So we do have, I think, a bit of a lack of a connection between the S&P and the Dow at the moment. Obviously, they're made up of different things. The Dow is only 30 shares. The S&P is 500 shares. So the S&P is a much broader index. But the Dow really struggles when it gets up to these levels. I think if we saw the S&P and the Dow both moved out to fresh all-time highs, that would be seen as pretty bullish. But clearly, the big level to watch on the Dow, 21,170. I can't help but feeling, these markets are due a correction of some sorts. But I wouldn't be massively bearish because you could see, what a great job these old lows have done. It's sort of ahead of 20,400 on the Dow. So even if we got, a sell-off of 600 points from where we are now on the Dow, there's still plenty of support just below there. But I think clearly a big level to watch. But it has been. You can just see what a dull week it's been. How tight. These are the daily candles we're looking at. These aren't 10-minute candles. Just how tight the range has been over the last week. Really, not much to say about that. But the Footsie's been interesting. The Footsie has, I think I just saw on Twitter, it's had its best month since the end of 2015. So let's have a look at the Footsie. There's our Footsie. Even as we speak, the Footsie is breaking out to fresh all-time highs. So there's the Footsie 100 trading at 75, 74-ish. So is breaking out. And again, the trend on the Footsie has been clear for much of this year. And we did have to put our hindsight trading hat on again. Now, there was a buying opportunity into the trend, similar, not the same as, but similar to the one we had on the pound, where it got sold off. Actually, this is just yesterday, isn't it? Sold off, so it dropped about 50, 60 points. But we did have this old support coming back in off these old lows, and maybe even back there at 74.70. So lots of support underpinning the Footsie. That's really getting a move. And I wonder, is the pound falling? What's going on? Why is the Footsie having such a surge at the moment? Is the pound? No, the pound's not doing anything. Okay, but so Footsie 100, definitely one of the better performing indices over the last couple of days because it is actually moving. If we look at the DAX, here we go, let's bring up the German 30. The DAX is getting moving. Clearly there must have been some data that's come out over the last hour that's pushing these markets higher. But the DAX, a little bit sideways, below those all-time highs, but plenty of support. From sort of 12,470 through to 12,550 sort of area. So still a buyer on weakness. When it comes to currencies, I mean, we've touched on the euro. The euro has had a good run, but is a little bit sideways and does have quite a barrier of resistance, sort of 80 to 180 points above where we are now. Pound against the dollar, I think there's a half decent chance for the market rallying off these lows because it has been such big support for this market, and that's really about it for currencies. Let's take a look at some of the commodities. Again, it's been something of a quieter time. Let's take a look at this is the price of gold, isn't it? Let's zoom out and get a bigger picture. For me on gold, my view is still the same, that the trend for gold is still just about up, I think, for this year. So this is a daily chart that we're looking at. So even though we've lost that trend line, we do still have the old big supports still left. What are those levels? Let's have a quick look down here. So big support still left ahead of 1190 and sort of 1170. So I still think gold is a buy the dips market, but it needs to crack this 1300 level to really open up the upside. a bit more. And crude oil has had plenty of volatility over the last week or so. This is a daily chart of crude, so we have seen, you know, plenty of big moves, but we're still trading roughly where we were trading at the end of November last year. So we haven't made much progress through 55 on the upside. There's definitely an appetite to be a buyer of crude when it dips back to sort of the mid-40s sort of level. But at the moment, trading at sort of 48.5, it's just stuck in the middle. Again, I think if you're a short-term trader, there could well be an opportunity in crude if you really want to sit there and watch it. So on the way up, on this trend in the way up, let's just plonk some lines on here. Hang on, wrong one. Horizontal. You know, we had support at 47.70, and then we had support at 48, and we're currently trading at 48.5. So I think it's an interesting one to watch if you want to sit there and watch it this afternoon or over the next 24 hours or so. How does it perform down here? You know, just last week when we came back to these levels, we did see, you know, a half decent 150, 200 point move. So I think it's going to be an interesting one to watch, see if we see the buyers come back in down here. For the fans of the squiggly lines, you know, we do have the RSI getting very oversold down at these levels. So it looks like, I think in the short term, there's a half decent chance of the price of oil finding some support down here. It's currently, what, 48.52 to buy. I'd change my mind if it lost this old support at 47.70, but I think there could be maybe a bit of a last gasp left for the price of oil, and we could see it move a little bit higher. So that's it, really. It's been a bit of a funny week. It's been a quiet week, but I think pound against the dollar, particularly over the next week and a bit, with the election coming, is going to be one to watch. The Footsie is still strong. Can the US stock market get a move on in one direction or the other, because volatility is so low at the moment? And maybe the more immediate one to watch for those who crave the action is that the price of oil, to see if we see some buying coming in ahead of these old levels. But we'll start wrapping things up there. We'll do this, of course, all again next week, which will be the day before the election. So that should be exciting. If you have any questions, though, you can drop me an email. My email address is david@tradeafter.com. I wrote quite a bit actually, about social trading. I've been running like a public social trading account and been updating it on my website. That's tradeafter.com, and I think it's up as of the last update. Was it up about 4%, 4.5%? I think so far, something like that. But if you go to the website, you can read about my progress on that, and that's due another update. And as usual, if you follow me on Twitter @JonesTheMarkets, I'll always try and tweet out interesting charts and stuff during the day if anything's happening. But we'll wrap things up there. Thanks for coming along. Enjoy the rest of your afternoon, and I hope you can make it for the same time next week.